Welcome everyone to the first digital finance seminar of the term. It's my pleasure today to introduce Pramod Viswanath. I hope I got that right. Pramod is the Forrest G. Hamrick Professor of Engineering at Princeton University. His research interests are in designing scalable decentralized systems, aka blockchains, and also using the underlying principles to design and build AI marketplaces. And today he's going to talk about AI meets programmable finance. Thank you.
Do I need this?
I don't think you need that.
Thank you, CMAC. Thanks for this invitation, and thank you for coming. This talk is on AI and finance. So fits this theme for sure with the finance there. But it's this thing called programmable finance. So I'll walk just by going around by saying what do I mean by programmable finance, and we'll take somewhat of just a conceptual view, first principles, define it, and look at some examples around it. And why am I doing this? So traditional finance, it's traditional. Finance is a part of our society, and largely the way in which the markets are set are, we could all agree it's rigid. You buy equity markets, they have Monday through Friday, Eastern time, they have fixed timings, privileged. Not everyone can run an exchange, not everyone even can participate at different levels, and even opaque in the sense of how they're regulated and what influences their policies. It's an aspect of finance. And participants are not necessarily left to be opaque, or they can be flexible, and indeed they are, and that's been a revolution ongoing, in fact continuing over the decades, largely AI driven. And they use information asymmetry, also technological asymmetry to arbitrage, and hence in some sense even out the markets. Hedge funds, quant funds are all high frequency trading. These are all examples of this revolution. So AI is already part of traditional finance that way. But the use is one-sided. What do I mean by that is that it's used by traders and participants, but not so much by the market makers themselves, which stay the same in their structures, in their policies. And this talk is about what if the market structures were also adaptive with the same kind of incentive structures that perhaps traders have. Okay, that's what this talk is about, and that's the kind of a hypothetical, and we'll work through this. In a way, this is already happening. If anyone's following just markets in the last, let's say, post-financial crisis, this is already happening, that new market makers have emerged from the sides, and basically the new banks. And they may have been small at some point, but they built their edge via technology and via both in terms of hardware, but also in terms of algorithms, and took over entire marketplaces. I just learned today that XTX is the 5th largest user of GPU after OpenAI, Google, Microsoft, Facebook, and then XTX. It's remarkable. It's a top 5 GPU user, so that says something. So they're heavily into deep learning and AI. And more than 1 in 4 equity trades go on Citadel. I mean, it's a Citadel trade. So it's a remarkable, so they are adapting, and they are offering now, they become market makers themselves, and they start offering markets themselves. So it's kind of happening, but it's not permissionless enough. In the same sense that traders could open a shop, prop trading desk. CMAC was kindly telling that he's run a prop trading desk himself. So not that level of permissionless, but that kind of spirit of permissionless innovation at market creation, not market participation, but market creation and market participation is already happening in the cryptocurrency marketplace. And it's a very concrete ecosystem to look at some of the ideas that we'll discuss in this talk. And so this is broadly called DeFi, decentralized finance, and I would say better characterized as programmable finance. The decentralized aspect refers to a certain set of features which are less relevant to what I'm going to be talking about. Actually, probably not relevant. So let's just call it as ProFi, or programmable finance. So what do I mean by that? What I mean is that you use the core principles of computer science, which is programmability, composability, that means functions can call functions, and atomicity. You can have things like and if and then and else together with financial markets. The power of programmability that come with sort of Turing complete expressivity together with market creation. You put them together, you have programmable finance. And it's not just a theoretical construct, as I pointed out, that already exists under the name and the rubric of DeFi. So what do and just some properties, okay? I said this is computer science meets financial markets. It's permissionless, so anyone can come to Ethereum and transact. You can even load your own smart contract and get people to use it. Really just needs an IP address, nothing else. It's composable. It's more like Lego bricks. Because these smart contracts share a common memory and a common action space, then you can interact with other contracts, and your contract call can other contract as just a function call. So they're simply function calls of one another. So it's like Lego bricks building on each other, and in as complicated a way as possible. In fact, it's programmable that way. And this composability is powerful, but most of all, it's atomic. So you can write things like, and this seems like a simple thing, especially viewed it from a computer science lens, super simple, which is that you want to say, I'll give an example. You're going on a vacation, and I will go on the vacation when things are right, which means I get a good flight ticket, and I get a good Airbnb where I'm going. Well, the Airbnb platforms are different from United.com, and by the time you go do your United, you found your flight, too bad that the Airbnb went away. And vice versa. You're keeping both of them on the books, so to say. Better yet would have been, I go to do my vacation at one place where both of them happen. If either one of them is not met or both are not met, then the vacation doesn't happen, or maybe happen somewhere else. So this kind of a functionality is super simple if you write it in computer science language, a way of thinking, which is I'll execute if price is less than something and nonstop, and Airbnb is close to the beach and less than some price. Super simple. I mean, you can just write it. It's just and ors and if and then statements. And but there are no atomic markets. You can't buy Apple stock if it goes below some price, and sell Facebook if it goes above some price atomically. There's no such thing. I mean, there is a need for such markets, and it's a risk because whoever is providing such services keep both of them on their books, so to say, in between when the trade settles. And of course, they'll take some cut around it, and they take maybe the risk. But the markets are not built to enable natively atomic transactions. It seems like a pretty simple thing. But DeFi comes naturally. There's nothing to even bat an eyelid on this. So this kind of programmable finance is a powerful feature that AI can especially take advantage of. And this talk is about exploring what AI can do with this kind of programmable functionality, especially in the context of basic financial markets. That's why this talk is AI meets programmable finance. And I look at two basic financial markets. This is like the most basic financial market. One is market making. I have dollars, I want to buy Apple stock, or NVIDIA maybe. Or I have NVIDIA stock I want to sell. Very, very basic exchange. And I would also like to look at lending markets, which is I have some money, I'm going to put some as collateral and borrow something. And somebody should be a lender because I have capital, I put it to use, and somebody is a user with ideas and energy and entrepreneurship, they want to lend, they want to borrow. Very, very basic financial functionality. This is like the two most basic ones. I want to look at these two with the lens of AI meeting programmable finance. And I have two kinds of focus through this lens. First, what you would think the AI can give you. It provides efficiency, adaptivity, flexibility. It just adapts and gives, it's just a better market. That's one. The second, which is perhaps less crucial and especially not as well thought of in the AI world, is this what I call adversarial robustness. When you have everything being open, including the policy itself being published, which is what you would do in these permissionless markets, then the other side can look at it too. And adversaries can play the same game. My son gave me this quote. So you want to be robust in the sense that an adversary with a small amount of capital should not be able to cause disproportionate impact. And such are the goals of this talk. And we'll take a look at what kind of markets might look like in this combination, and what might they be good at the very end. All good? Please ask me questions during the talk as you come along. Okay. If the setting is good, then I want to go to the first first topic, which is just market making. And you have the market is called exchange, and you want to swap ETH for USD, and basically you make some statements like this: I want to buy this much amount of ETH, but price no more than that, and things like that. And somebody else probably wants to sell ETH, but a price at least this much, and you want to find a way they can be exchanged. Such things are called limit orders, and you put them all together, a whole bunch of them, and a market maker or the exchange publishes two prices, the so-called ask price and the bid price, and looking at a whole bunch of such limit orders. And question is, how do you set this bid and ask? That's a very basic question, and of course the difference between the two is the so-called spread, is where the exchange makes some profit. And you ask, how do you set these things? What's the right way to think about how to set? And this question is from 1980. This model to answer this question is by Gloston and Milgram, economists, from 1980, which had a very canonical model and a classical economist view of formulating, a rational economist view of formulating this problem of setting the bid and ask prices. So they do the following. They said, first of all, what is the model? The model models two things. First, it models the trader behavior. They say first it models the asset price. So there is some asset, let's say the other asset is dollars or something, fix it. One asset, and there is a price, but nobody quite knows it, and you model it to be some kind of a random process. And traders, that's the part of the model. The second part of the model is they observe the price through some noise. And in particular, you can have two kinds of extreme kinds of traders. One, what Gloston and Milgram calls informed, which means they see the price exactly. So they're like oracles, they're savants. And you can call shrimps, aka chumps. They don't know anything, they think they know, but actually they're just looking at noise. In which case, they just trade randomly, and the informed traders ran really correctly. If the bid and the ask, if they are in the right range, and my price is in the middle, then I stay silent because the prices are too good. But if the price is too cheap, because I know the real price, then I'm going to buy, and if the price is too expensive, then I have the asset, I'm going to sell. So they can do very sharp rational decisions. These guys, they think they might be, but they're actually just trading on noise. This is the Gloston and Milgram model, and Gloston and Milgram asked, now that you know this, and assume that the traders are behaving rationally according to their level of information of the underlying latent asset price, they ask, what should the bid and ask by the market be? And they postulated that whatever you do should be efficient. That means the spread should be small. At the same time, should be, so that's the information theoretic one. You should make it as small as possible, while not be profit taking, because you have always, as a market maker, you may want to make some money, so you want to spread it, and that spread is where they take their cut. And because they sell at a higher price than they buy it at, right? I mean, you go to Forex, everywhere this is the standard exchange. And but you want to keep it as small as possible. In fact, the competitive market makes exactly zero profit. The idea, this is the sort of a rational view in economics that says that that if you are making profit, then somebody else will offer the same product with just just a bit less, and eventually nobody makes a profit. I mean, in practice that's not quite how it works because it's not easy to recreate maybe, but that's the pure economist view. It's good. And in that paper they said it's very simple. You set the ask and bid, ask price and the bid price to be simply conditional expectations of the random variable that you didn't see, which is the asset price, conditioned on all the trades that you have seen. And in particular, the current trade, if it's a buy or a sell, will tell you whether it's the ask or a bid price. So it's a conditional expectation over a very long sequence of trades. And in particular, as the time goes, then you have more and more information, but the asset price could also be changing. You don't know how it's changing. That's also changing in time, and you keep adapting to this. And the key question, of course, is how do you compute these quantities? That's not an economist to worry about. It's hard because you don't know how to compute these expectations. If you know the underlying distributions, perhaps, so we'll get there. So how do you compute these conditional expectations? Well, maybe if you knew the underlying distributions, which is the kind of the hidden state, what kind of random process it was. Perhaps it was a random walk. In fact, that was also the Glaston and Milgram's model. And AMM is the market maker, automated market maker, that exposes the prices, that exposes the bid and ask, and the traders react on it. Notice the traders are also coming to be randomly chosen, either informed or uninformed, and the market maker doesn't know who is informed or uninformed, you just see the trades. And in Glaston and Milgram model, they made a simple assumption that you trade only one unit of asset. At any time, one trader comes, chosen randomly between informed and uninformed, and there's just and they come and make one unit of trade. So they set it up clean. And such a thing where you want to figure out what the market maker's action should be so that you are efficient is I mean, there's a Markovian structure, presumably because asset prices are, let's say, a random walk, I said. So it's clearly a Markovian thing, but it's hidden. You don't observe that for sure. In fact, you don't even see it directly because you go through some decision process in the middle. So it's partially observable, but it's also a decision process. And this is a whole category of sequential decision making problems, largely studied in a variety of settings, and this is sort of a categorization of these settings to give you a feel. The classical setting, the very classical, the first time where such decision processes were studied is where the state is observable, the transitions are also known, and you ask properties about estimating what will happen. And this is dynamic programming, classical decision making setting, and how to learn during decision making, dynamic programming. If the state is observable but the transitions are unknown, then you have things like Q learning, also classical with strong guarantees, maybe not as classical as dynamic programming. The next one, a bit more sophisticated, and I don't know much about this myself, is that where the state is not observable but the transitions are known and the associated actions or the samples, emissions so called, are also known, they are also observed.
Emissions, you mean observations?
Observations, yeah, exactly. I use the word observable, so I didn't use observations, and I think people in that literature use emissions. But really observation, that's what it is, but there was already an observation.
Observation of the state, but some derivative.
Yeah, some derivative, that's what it is, like because some version of action on top of it, like trader action would be classical version. But, and there are convergence guarantees there too. But what we are looking at is the bottom one. I don't know the state is not observable, and the transitions are also not clear because I don't know, I mean, Glaston and Milgram model it as a random walk with some probability, but like how do I know what these things are? I don't know them, and I don't know the emissions either, which is how the traders are acting. Because trader distribution, Glaston and Milgram said informed, uninformed, with half-half, and they also said, yeah, and they're extreme cases. But in general, why should it be half-half or 70-30? I don't know where these things come from. So I don't know the emissions either. And this is exactly where AI comes in. So far, notice that you wouldn't call those other things as AI. Maybe nowadays you can, but at the time people didn't call them AI. When CMAC did his PhD, he worked on reinforcement learning, so it was called something else. But today, all of this got absorbed in AI. And no guarantees, But hey, I mean, you don't argue with success when AlphaFold works like Nobel Prize winning. But there are no guarantees. And the key observation here is that if you want to make anything work, you have to have some heuristics, and the heuristics really need to exploit some link between the observations that you have and what you don't observe, which are the hidden state. And if you really want anything systematic, especially if you want theoretical guarantees, then you really need to nail down this connection. Turns out there are two key links here in this case. Even though I observe stress trader behavior and I don't know if the traders are informed or uninformed, and I don't know what the asset prices were to begin with anyway, and I don't know what level of informedness the trader were working under, I do know a couple of things. First, because it's supposed to be a competitive market and only one asset price is bought and sold at a time, if it's really competitive, that means I set my bid and ask correctly, then the number of buy should be equal to number of sell. If there are too many buys, then you know what, maybe your price is not set high enough. Market will be, we will look at just looking at the number of buys and sells, especially the difference, the imbalance will tell you something about what where you are setting. And the second one is that the spread shouldn't be too large, and you want to penalize that spread. It may not be 0, but it should go down. Put the two things together, and then you have a reward function to work with, to do an online optimization to work with. And any one of them is not enough because they're kind of not well set. You can make the imbalance very small by just setting ask and bid like basically very hard, and then why would nobody will buy or sell, then of course the imbalance is 0. That's not very helpful. And spread can be made 0 by, you can just set bid equal to ask, the spread equal to 0, but then the imbalance just goes through the roof.
So this imbalance is an inventory cost we should take away?
No, it's not inventory cost. I'm going to come to this, Agostino. Imbalance is simply the difference between the number of buy and sell trades.
Like in the last slot?
Good. Okay. So maybe you can take some window. That's also something interesting actually, because by the time the asset prices have changed, you may also want to have a window over which you keep track of imbalance. Imbalance is simply how many buys and sells.
No, I'm thinking why it impacts negatively the reward.
Oh, reward was positive. So negatives are just because I want to maximize reward. So you want to penalize imbalance, penalize spread. That's for sure. But inventory is an important point. It's related, but we will come to it. Not yet. In the Glaston and Milgram model, you buy an asset 1 unit. Idea is that it's liquid markets. So we didn't talk about it. I mean, they didn't mention it, but that's the implicit idea, is that this is very liquid. So buying and selling, there's no issue. Sorry?
Why do people trade?
That's a good question actually. And some people simply because they want another asset. I mean, I don't know, this is not part of the model, and it's also not my role there. But presumably some people want to make arbitrage. They have information asymmetry and they want to use that. And some people perhaps just want to get the asset maybe. This why is kind of a good question. We'll come to it when this psychology is not as relevant here. It's hidden inside just the informedness level. And if it couples with the decision making, then we will be interested in it. And that will be true in the lending markets. Here, not so much. We have decoupled how the asset price is changing with the informedness level. So why would why would somebody trade is irrelevant if it actually affects the price itself.
So here you're looking at it from, this is the reward for the market maker, right?
This is how you set, this is all about market maker.
Doesn't the market maker just want to make money?
It's true. In the Glaston-Milgram case, you try to make too much money, then somebody else will undercut you. So this whole setup is competitive equilibrium.
Okay.
Good point. Of course, market maker, that's what they're trying to do. And all those market makers I showed you examples of in different market segments, of course, they're in the business of making money. But they offered significantly better rates than their competitors, especially the big banks, iBanks.
But if they want to make money, why there is a negative spread? It should be plus the spread. If they say
No, I want to minimize this. I want to maximize the reward and
maximize the reward,
minimizing the spread. Yeah, I mean they do want to make money, but in this setting they'll make exactly zero money.
so why do they want to minimize spread? Because they are competing with other market makers.
Presumably, this is the competitive equilibrium. This is the Gloucester and Milgram model. I like it. It gives me some principles to work with. And this is the whole point, is that once you set this, I mean, that was the intuition, and now we do some work, and shout out to my student here, Viraj Nadkarni, some weightlifting, and so this is sort of a new result itself, because this kind of a POMDP is unusual. You have to do it artisanal proofs. These are not something you cut and paste from elsewhere, because it's one of their kind, and you have to go lift it. And the argument is that there's an online optimization with that reward function. It's changing over time, and as Siamak correctly pointed out, you may have to have some windowing over the imbalance, exactly, and put them together. Any method, I don't care exactly which method you use to solve that online optimization problem, but if you do well, then the policy that you get, that means policy means bid and ask prices, are the right ones. That is, they give you the smallest spread possible information theoretically. The implicit assumption here is that if the price jumps, this is the Gloucester-Milgram setting, just one time, then you will converge. The bid and ask prices settle down to it exponentially fast and things like that. But if you have volatility, which is always changing, then the spread can be shown to be just bounded, and you can sort of calculate what that is as a function of volatility. It's also possible that volatility and informantness themselves vary over time. Just like volatility changing means rate of change of rate of change. So you can try doing that. So that's on the left, where and what we find, this is not covered in the theorem. The theorems are more like stationary settings, and it seems to handle well when we try up to some point. I mean, you try kicking it, and at some point when the volatility goes through the roof, and if like time to time, then you have something else to work with. And that's the beginning of an AI meets market making, where I look at the trades possible and use that to come up with an online policy that adapts as and when the market traders who participate in the market respond to me. One thing that was Agostino already mentioned is that there in the model so far you can buy and sell price assets, but what happens if the inventory market maker has to have things on its books, and what happens if you are hitting some limits of inventory? And this especially makes sense in things like less liquid markets, or if they can make arbitrarily large bids, especially in the case of DeFi. You can't prevent people. Once you publish a price, they'll just go and buy it. Then inventory becomes super important. And this is an alternative or a complementary aspect to Gloucester-Milgram model in classical economics. And what you really want is you want to actually have now not just a bid and ask price, which was for a unit asset, but actually a bid curve and an ask curve themselves. A curve as a function of what asset size you want. So you tell me how much you want to buy, I'll give you a price. And there's implicitly, previously it was linear, but there's with inventory you probably don't want that, because if you misprice once, then they'll just max out, and you're in trouble there. So you want to actually, as the inventory gets closer, you want to make the price higher for sure. And this kind of a problem where you want to extract information from multiple parties by setting up a market are called betting markets, and you want to kind of repurpose this thought process and this design process to asset prices, and bring our lens of data driven AI enabled market making.
So here one challenge that you don't know the inventory of the other market makers.
No, I don't know the inventory.
You can use AI to infer.
We will get there actually. So let's start with when I know the inventory, and this market maker knows my inventory, and such a thing where you have a curve, bid and ask. You can have two separate curves, and Siamak and Jason here. Is Jason here? No. Okay, so they've been working on a series of works here where they also have a very correct notation of the model, which we respect in our papers, but here I'll use something more classical, something called a bonding curve. The bonding curve basically is a way of saying how much price if you want to buy or sell for what asset value. It sets an operating point that depends on the inventory, and you just follow this curve to say The x-axis and horizontal and vertical axis are the two assets in inventory levels, and you want to buy something, then you want to buy ETH, then you move up. If you want to buy USD and sell ETH, then you move here. And wherever you are on the curve, that's your price. And now that you are doing this, you might as well generalize the Gloucester-Milgrom model, because that's the lens at which I am looking at all these market mechanisms. And generalization is in twofold. First, I don't have to, both of them got generalized. So the asset price itself could be not just one unit, jump up and down. It's not just a random walk, you could just add some noise to it. Think of them as, you can add Gaussian noise. I mean, you can think of them as Brownian motions, discrete time. You can model variety of ways around it. Second, the traders don't have to be just this black or white, informed or uninformed. I can have some noisy notion of a trader, and it's a whole continuum of it.
So is one way to, in a lot of financial models, there's a common value component, which I think would be like your external price, but then an agent might have an idiosyncratic value, which sort of feels like is that the flavor?
What the traders are looking at. I mean, this is a very natural generalization of the Gloucester-Milgrom model. I just allowed for having just instead of two types of traders, I allowed a whole continuum of types of traders. And instead of just saying the asset price jumps by +1 -1 with half-half, why? I mean, I allow more general probability transitions. So a natural one. And you can look at Gloucester and Milgrom, their objective. The objective says that the expected profit by a trader while interacting with the AMM should be exactly 0, and the price should be set in such a way, or the bonding curve should be set in such a way that this happens. And how do you set? Well, here this is information theoretic, so that means you look at all the past trades, you know what previous bonding curves you had, and you set this equation. It's again this is now a functional equation, because notice that the price is actually a curve at any time, and its equality is like for all values of asset sizes. It's continuous not in time, but it's continuous in asset amount.
So your model for the arriving traders, they come and they trade until it matches their value?
That's it. Excellent point. I think I said it here, but I jumped here.
So is there a notion of budget, or like will the trader trade as much?
I think we say as much as they can to max out. We could also model some of those trader limitations, but I just want to get to the market maker point of view. That's right. It's also possible the traders have some budget. And you can ask again the question, what does this equation tell you about what the bonding curve looks like? And the Gloucester-Milgrom condition, you write this down. Notice that there is some kind of it's a differential equation. This conditional expectation. It's a differential equation that couples the bonding curve with the trading actions, and you average over some distributions of both the state transition and the emissions, the trader informedness.
Trying to understand the traders, what do they have? Do they optimize any objective, or they are a demand function?
Actually, CMAC just said that. So traders are rational, so they have an estimate of the price. They also see the other trades, and maybe they have actually external information. Presumably, that's a proprietary information they bring. That's why they're trading, because they know what the value is.
Is it reflected in the model? Is it the demand B?
No, it's reflected in what their action. The action is they make an estimate of what the asset price is based on what they know. That's the information they bring. And if the bid and ask prices, depending on what the price bonding curve is, if they may choose to not buy at all because it's right in the middle, or if it is cheap enough relative to what I have, they are going to buy until the price hits the value that I think the asset price is. And conversely, if the price is prove too high, then I'll keep selling until the price matches what I have. It's a rational behavior. These traders are rational. They're acting rationally, maximizing whatever they can. Previously, there was just one unit, so they could just buy or sell just that, but this is a generalized version of it. And the differential equation can be solved. I mean, it's a closed form enough, but if you know the underlying probabilities, both for the state transitions and the asset price transitions and the trader informedness itself. And if you make some classical assumptions, like Brownian motion asset price and some trader distribution being Gaussian, sampled from a with Gaussian noise, then you can solve exactly Kalman filtering to solve this differential equation. But that's not enough, because I need to, that's just the curve. But where do you operate on this point? That's the first place where it's like an operating price point I need to give you to get the whole thing started. Then that is set based on some kind of some kind of implicit equation, so fixed point equation. Except when you have some classical assumptions, you can just solve paper pencil. You can solve by hand. And once you start doing this, you can ask, hey, people use static curves. Nobody uses dynamic curve changing by time to time. They may change it once in 3 months, depending on some community vote, but nobody is changing that regularly. And for example, curve, balancer, Uniswap, there are later versions of Uniswap, they are using this, and this kind of for some parameter theta. And you can ask what dynamics of state transition and informedness would this be optimal. And basically you need very unreasonable conditions. Some of them have been observed already. I mean, Hamrick wrote this paper which was talking about how low gas fees, small block times seem to make more efficient markets on DEXs. I mean, you see that also here, I mean, in some other way. Yes, question?
Yeah, so I have a question on, in your model, how exactly do the traders see the curve price?
Oh, so that's a great question, thank you. It is not a model, that's actually what I call, I make a distinction between model and mechanism. So if I go here, just the previous one, this is not a model, that's what I call mechanics, or somebody like me who is an engineer call plumbing. And that has to do with a smart contract representation on DeFi, if you know DeFi. But what is actually happening, roughly speaking, I'll tell you the mechanics, is that a whole bunch of people with assets pool together in a distributed way. They just pool it into a contract. That means they deposit money into that contract, and that contract represents the market making functionality. So this is not a model, it's a mechanics, and such a thing is what I call peer to pool to peer. A whole bunch of money comes in inventory, puts together into one common pool. That pool is managed as a contract in DeFi, if you follow DeFi and closely. Then that smart contract exposes the functionality of market making. Usually it exposes it through this bonding curve. And what I am proposing is that you should adapt it all the time. No need to wait for a 3-month community vote and gauntlet to approve it. Or this is maybe AI replaces that, and they are using MCTS too, so it's not like they're very far away. And this kind of a work, which is which kind of curves work best, where, how, what are the corresponding effects, what kind of fees can you put, what is the effect on volatility, how much price, because the guys who are first putting the money in are always loss making, and how much loss would they make, how to reduce that, how to quantify that as a function of volatility, and how to reduce that if at all, how much profits can they make, whole bunch of works. The expertise is right here in this room. There are other ways around it, information betting markets viewpoint here, and in the middle was slightly somewhere in between with Goel and Goel. And largely this is a large and very active area of research. Not so much from our viewpoint, especially dynamic data-driven view, but in perhaps equally good and interesting axiomatic settings. I mean, we have axioms too, but that goes back to Glossum and Milgram and very competitive equilibrium settings. And that was the question, which is how do you sort of implement it, and what's the mechanics? All I say is that this is just a varying curve, and this kind of functionality of implementing already Uniswap provides hooks. And this kind of programmability, Uniswap is a major exchange that offers such functionality. It's a smart contract, and the later versions offer easily the programmability to implement it. And one can now approximate, once you have the curve that's coming in, you can approximate it as a update policy on Uniswap's positions. all good if I can find that optimal curve. That optimal curve requires solving the differential equation, and by hand we can solve if we make some Brownian motion assumptions, but the whole point is data driven. I don't know what they are, and I would like to actually not know them. In fact, my goal is to just do good market making. I'm not trying to learn the underlying structure of the universe, or also in what's in people's mind. Why am I doing what am I doing? I would like to just do good market making, and just to come up with this curve one time. And so it's a POMDP again, except it's continuous state this time. Previously it was just two numbers. Now it's a whole curve, and in a way it got generalized, because now you are doing a whole curve instead of two numbers. But the interesting thing is that it also got simplified. And the reason is, previously the market maker could only publish two numbers, bid and ask. And you try to learn and infer what the states might have been from just the noisy trader actions on just two numbers, bid and ask. And they can only buy one price or less. Now they can express their belief in a whole curve, and traders also react by expressing their view in a very precise way. If they buy, they'll also tell you how much they buy. So that reveals their position actually, which you did not have access to earlier. So it's simplified, and it's kind of a priori counterintuitive, but one thought about it and you see that it's there. And so now you can start bringing these ideas, and it's Kalman filtering again, except you have to sort of adapt data driven Kalman filtering. Such things exist, and one can now use that to set up how to learn such a what I call VFMM. It's a variable function market making. But one can take it even further. Whenever I want to do experiments, I want to push that until it kick it until it push and kick until it breaks. So in particular, I want to do sort of non-stationary things. I want to change the volatility itself to make it volatile, and I want to change the trader behaviors and the distribution to be even more than just stationary. And once I start doing that, I'll see that at some point when the volatility itself starts varying too fast and over time, then eventually you'll start losing the power of this adaptivity. And but trader behavior only gets better. If the trader noise is more, then you just adapt even better. And one can also try non-stationary settings, which is what I just alluded to. Yes, question.
How do you measure the monetary loss?
Good question. What is monetary loss? Okay, good. Let's first check that. Okay, I wrote that, but I didn't went through it fast. Monetary loss refers to the trade that you make relative to what the actual price was, if you had paid the right price for that asset. And the difference, relative, normalized, is what we call monetary loss.
The right price is from the centralized exchange?
No, there is a true asset price. There's no centralized. I mean, you can think of it as maybe centralized, but that's not the way I was thinking. This is more conceptual. So there is a true oracle price, and with respect to that.
So what you call the external price?
What I'm calling the external price, exactly. And that could be something drawn from some other source like a centralized exchange. Yes, possible. In blockchain case, actually, that's more true. You draw it from Binance. That's right. This is one part of the story. I said I have two focuses and to my AI lens. One was I wanted to be adaptive, I want to be efficient, data driven, and move with the same agility as traders move. That's been my theme. But there's a counter theme, which is here the trader strategy is transparent. Why are people trading? And I don't know why, but I know their strategy. They are also making an estimate of some form of information about the asset price, and they are behaving rationally with respect to it. What happens if they don't behave rationally? That means adversarial traders. They could be behaving because their incentives are not in this market, but some other market where you have some outsized potential benefits. This happens, still financial incentives, and you may want to, if you're using this market to get the price, and that price was used in some other markets to offer derivatives and options especially, then then you have then that's one type of, that's why you may behave adversarial. You may take a loss now, but with the idea that in another protocol you benefit. And or you may have completely external incentives. You are purely loss making here, but with the idea that you're going to win big somewhere else, completely somewhere else, and that's not even financially captured anywhere in this in these units, and perhaps polymarket. So how do you handle this? And in particular, we can ask, we have a strategy already, right? How does so how does this work? Well, if you within the internal incentive setting, that means if you're just asking, the trader can take a certain amount of loss. They have a budget. This much amount I'm willing to take a loss because I'm behaving kind of irrationally or non-rational according to my informativeness. Then turns out they can't move the price beyond that much. The reason is the trader behavior is indistinguishable from irrationality to the underlying distribution itself. The market maker doesn't know whether they are behaving which way because I don't know the underlying distribution. So it just translates into another distribution. But because I was being data driven and I was agnostic to what the underlying distribution was, I still kind of catch that. So the mechanisms that I have proposed and the algorithms proposed here are inherently robust to adversarial trades as long as the incentives are calculated in the same units. But if the units are some other thing and just a few wallets completely swing, or a few $100 million of betting on Trump versus Harris, and just 4 wallets, Polymarket announced recently this is controlled by one person, have like a 10% of the stake or a little bit more than 10%, they can sway a substantial amount in the margins. And just 1%, turns out you look at those usages, the whales are just 1%, dominates that usage, dominate the trades, and one person just has a significant stake. Those are different type of markets, and adversaries, low liquidity markets, adversaries can, especially if their incentives are outside, have an outside stake. Still interesting to think about how to do data driven. If maybe you saw these 4, maybe we should just weed them out first. I don't take them into account when I do my trades. People do this in robust statistics. They look at points and they take out the extreme points, extremal statistics or robust statistics. And given that what I'm talking about, Kalman filtering reminds you of statistics, one can also ask what's the equivalent of robust statistics view of this whole approach, which is, except this is a decision process, so it's coupled, it's not just looking at static data and removing the outliers. Here you have to think of which trades are outliers relative to the Glostam and Milgram's implicit equations. So it's not as if which ones are suddenly came, it's not just the timing. So you have to look at it a bit more sophisticatedly. Now one can do that, and let's call that robust Kalman filtering. And there are some works around it, recent machine learning works, which look at such robustification. And yeah, so now you can learn such robust calculations, and what you get is, you get some robustification. But still an open question is, what about an adaptive adversary that is not simply following, statically making an adversarial action? It knows that you're doing this formula, in other words. This is what I said, by the other side can do magic too. If the algorithm is published how I'm going to do the market making, then they know that you know, and so they can do some other thing. And so how would you take care of such adversaries? Open question. Same with non-stationary settings. There you go from filtering methods to deep learning based methods. And while empirically things seem to work efficiency wise, there are no, I don't know what adversarial guarantees are. In fact, this problem of adversarial guarantees even in very basic machine learning settings are hard, like classification. This is the area of data poisoning and backdooring attacks and robustness to them. And doing such analysis and robustness to attacks on decision making processes, largely unexplored open problems.
There used to be some particle filtering methods that works in this case.
Yeah, but you want to be adversarially resistant. I think it's interesting to explore. someone's looking for PhD topics, this is a good place. Yes?
Just in the context of like DEXs, like traditional DEXs, if you were to separate out like transactions made by like MEV transactions or bots, like won't you get like data that is specific, like just noise, and then base your curves based on those traits?
Yeah, yeah. So this one is kind of, yeah, I mean, the question really is that, well, actual data coming in, the trades are mixed up, there are kind of other incentives, MEV, and bundled together, so that's right. So to do them online, and also where do you get this data, because this is interactive. The actual data you may get from Uniswap, but that was static prices, huh? Whereas this one, you want something as a process. Not quite there yet. So this algorithm is called zero swap, and we have implementations of it and so forth. We can talk about that. In fact, maybe I should go to that part given the time. So I'm just going to, the lending markets are available, so I'll just lead you there. I'll just go here. I'll summarize from where I started, because I started at somewhat okay. So our works are online and published in a few places, so you can read them. But mostly I'm in an engineering department. I build. I'm an engineer, and I'm an educator as well. So we teach this class at Princeton. It's open. It's run on Ethereum Kovan, so it's an online class in a way. It's online as in like literally online. And one of the goals we have in this class is that we have a wrapper. I call this AI to chain or ML to chain, which uses current technologies, plenty enough roll-up methods to allow this building, where you code your contract in Python. You code smart contracts are, if you've done any contract, you know it's very, very small pieces of code. They're hardly smart. But this is making them actually smart, and you run your trade. So this class is run live, well, in class through these such contracts. Easy to find us, web3.princeton.edu. And so that's what this talk was, programmable finance, but from an AI point of view, where the markets themselves can be AI. But I want to look at the other way around. What is finance good for? And it's, of course, it's a fungible thing, so you extract out the essence and you can drive any productive utility. I mean, that's the idea of finance. But there is one particular utility that programmable finance is specially built for, and I'm especially interested in this application. And done well, this would also be the killer app for crypto, which is to do with crypto platforms are great for bringing permissionless participants to play in games that I can or anybody can design in a Turing complete way and manage incentives in a very sophisticated, called tokenomics, but I can set all those fine-grained incentives and people will play the game. And the games are managed interactively and with all the record being kept. So I'm especially interested in such platforms to get the information that is what we call derivational traces, or the steps in which the games were played. And yeah, this is the last slide. And this such kind of derivational traces are the building blocks of the current race to build AGI, where you put basic rules of life, biochemistry, hydrogen, carbon, oxygen, basic building elements, put them under pressures, short term survival, long term evolutionary pressures, and the intelligence came out of that. That's evolution. And these are games that are specifically built to elicit such strategies. Already this is an active area of research in AI, but it's made for to be built on programmable finance platforms, I mean aka crypto platforms. So having said that, if there are students here, which I hope there are, I do want to encourage you to participate in one such platform. This is in the Bay Area in a couple of weeks, where you may have played Mafia, and I mean my kids do, so and I played with them, and my grad students are saying they fancy themselves. I can say AI does very badly. I promise that, I guarantee you. And this is about generating the next era of AIs from bots playing such games. And I'm especially interested in the annotations that come while you play the game and train the AI from such derivations. This is where programmable finance, AI met programmable finance through all the algorithms, but this is where programmable finance directly contributes to the development of AI, maybe AGI. Thank you.